This is my strategic predictive analysis based on my research. Why does the Genius Act prohibit stablecoin issuers from paying interest? Pi Network's interest-free philosophy and migration terms. Introduction. A striking feature of the U.S. stablecoin bill, known as the Genius Act, is its explicit prohibition on stablecoin issuers paying interest. At first glance, this may seem like a simple safeguard, but in reality, it signals something much deeper, a structural redesign of money. When examined alongside Pi Network's philosophy and migration terms, the picture becomes even more intriguing. 1. Why does the Genius Act ban interest on stablecoins? The ban is not arbitrary, it is strategic. Debt prevention. If issuers were allowed to pay interest, they would reinvest reserves to generate returns, recreating the very cycle of debt-based expansion that burdens the global financial system. Money versus investment. Paying interest turns money into an investment product, which destabilizes its role as a *neutral medium of exchange. Debt-free simulation *. By removing interest, stablecoins are locked into a controlled experiment of debt-free money, free from the compounding burden of legacy finance. Answer. The Genius Act's core mission is to test a new foundation for money, one that doesn't spiral into endless debt through interest. 2. How does Pi Network align with this principle? Pi Network didn't wait for legislation, it embedded interest-free principles from inception. Contribution-based rewards. Mining Pi or validating the network is not an investment, it is a contribution of labor, energy, and trust. Migration terms. The rules clearly state, one must not expect profit from acquiring Pi. This protects Pi from being legally classified as a security while also ensuring its philosophy remains intact. Answer. Pi is more than compliant, it has already realized the Genius Act's philosophy in its core design and binding legal terms. 3. What does interest-free money actually mean for the economy? Removing interest reshapes the dynamics of money itself. 1. Debt mitigation. Without compounding interest, national and household debt burdens stop snowballing. 2. Contribution economy. Pi shifts value creation from financial leverage to human validation, participation, and productivity. 3. No rate equilibrium. Instead of relying on central banks to raise or cut rates, Pi's 20% staking reward becomes a built-in stabilizer for money circulation. Right finger answer. Interest-free money marks the end of the formula, interest equals perpetual debt expansion, and introduces a new equilibrium centered on people, not banks. 4. Does the Genius Act represent a final solution? Not quite. While banning interest is significant, stablecoins remain dollar-pegged and thus tied to fiat's debt-based architecture. They cannot fully escape legacy constraints. Pi, however, represents the next stage of convergence. Debt-free issuance rooted in labor and validation. Staking as circulation support, not as speculative yield. Human-centered trust through KYC plus AI verification. Philosophical and legal safeguards that ban profit expectations. Decentralized CPU infrastructure * that enables self-sustaining growth. My answer. The Genius Act is a transitional experiment, but Pi embodies the final model of debt-free, interest-free money. Strategic conclusion. The Genius Act's interest ban is part of a broader U.S. debt reset strategy. Pi Network has already gone further, building interest-free principles into its DNA. By rejecting profit expectations and interest-driven expansion, Pi offers the true debt-free alternative for global finance. Predictive conclusion. The Genius Act may be remembered as a stepping stone but the true convergence point is the Pi ecosystem a model where money is free of debt, interest, and speculative profit, and instead anchored in human contribution and trust. My final question to pioneers. If global finance is slowly converging toward Pi's interest-free model, the real question becomes, will pioneers recognize that they are not just early adopters of a currency, but the architects of a new, debt-free financial era?